Hello and welcome to Moneycontrol. Hi, this is Nickey. Hindalco has reported somewhat weak set of numbers. Higher energy cost and input cost pressures have weighed down on the operational performance of the company, just in line with most of the peers that we're witnessing even across the globe. But how's the road shaping up? Let's ask the managing director of the company, Mr. Satish Pai. Mr. Pai, thank you so much for taking out the time and speaking to us. I'm going to start off by asking you about the outlook for the second half of the financial year for the aluminium upstream, downstream, and copper business in the order that you'd like.
So I think that the copper business has already had two great quarters, and we see that trend continuing in Q3 and Q4. The Indian aluminium downstream business has also done very well, and we see that trend actually getting more strong in Q3 and Q4. The aluminium upstream business is where the cost pressures that you mentioned are quite visible. But we think that the coal availability and coal pricing has peaked in the second quarter, and pricing and availability should start to moderate in Q3 and Q4. So we do expect that the upstream margins should improve as we go forward in the rest of the year.
So it would mean that the cost of production is expected to be lower for the upstream business, and the margin performance also is expected to improve for the upstream business, right?
That's correct, Nikki. So that's correct.
Any specific number that you would highlight when you say you are expecting a lower cost of production coming in the second half? A ballpark understanding?
So in our analyst call, we have guided that Q3 will be 2 to 5% because it will take some time for the coal to come into inventory and then get used. I think in Q4, you will start to see a much bigger drop in the cost of production. But we are not given any guidance yet because we want to make sure in Q3 how the coal availability comes in and at what price it comes in. I mean, the single biggest impact that is there on our business is availability and price of coal today.
Sure. So 2 to 5% for Q3 and a little more than that in Q4, but you're not providing a guidance just as yet, right?
Yes.
All right. We've already spoken on the cost of production. I would also want to ask essentially about Novelis because I think that's where I'm sure you've got a lot of questions around this. That suddenly we've seen an increase in the guidance coming in the August, and now we've seen certain amount of guidance coming in on the lower side for EBITDA per ton, of course. Though I'm sure you would say that the sustaining EBITDA per ton guidance is more or less remain the same. But we have highlighted certain amount of cost pressures for Novelis. How do you see the outlook, and when do you see a stability coming in on that business for you?
Yeah, I think that, the unfavorability on the Novelis side is fairly clear. It's the high cost inflation that's visible in the Western markets right now. The LME and premiums have come down, and hence the scrap benefit has come down. And there is this tremendous volatility in the energy prices in Europe. And of course, the higher cost inventory in the system, which got built up during Q1 and Q2, will come out in Q3 and Q4. So, which is why you see on the top line, whether it's demand for can, demand for auto, demand for aero, we are seeing that the demand side and hence the delivery side, we are very confident of the top line for Novelis, and hence we believe that in the next 2 quarters some of these headwinds will work themselves out, and hence we are confident that we will continue to meet our targets of $525 a ton.
All right, but you are seeing certain amount of cost pressures for Q3 and Q4 because I was on the Novelis con call and there was a sharp margin compression that was being guided coming in for Novelis. So if you could ballpark, just put in perspective that number and what are the measures now the company would take in order to, barring the demand, of course, to of course bring the EBITDA per ton back in control.
So as I said, I mean, we have guided 75 to $125 per ton down. And for it to come back, we are expecting the high cost inventory to go out of the system in Q3, Q4. We are expecting the scrap spreads to normalize. We are expecting the scrap benefits, that's why, to come back to normalized levels. And of course, the energy prices in Europe have dramatically come down. And we would, if they stay at these levels, then these headwinds would sort of unwind over Q3, Q4. and you will start to see by as we get into the new financial year of FY24, we are hopefully back to that 500 plus EBITDA per ton.
Sure. Also, a word, I'd want to understand because there is the 30% trim when it came to the Novelis guidance. It is an uncertain environment right now. Do you think the same can extend even on consolidated basis for Hindalco as a whole? Are we looking at some amount of capex that coming in even on the group level right now?
So we have been very clear that most of our committed projects we are going to continue full steam. All what we have said is the start of any more new projects, we will try to moderate it if we see that we have to stay within cash flows generated. Because the commitment we have given is that we will not borrow to do projects. The commitment that we have given is that the Novelis net debt to EBITDA will stay at around 2.5. So, with these financial constraints, all we are saying is that for new projects, we will moderate the starts to stay within cash flow. All the existing projects, especially the 2.5 billion Bay Minette project, the Indian downstream projects, we are going full steam ahead, Nikki.
So, what is the net debt to EBITDA level that you expect to maintain by the end of the financial year, and what is the level right now?
We are at 1.47 on the console, 0.47 in India, 2.4 in Novelis, and we should be about at 1.5 to 1.6 on March 31st uh, of this financial year end.
Sure, I'm going to touch base on the copper division in just a bit. But before that, I would like to ask more on the hedging strategy. What's the level in FY23, and would the company want to increase it in FY24?
So, currently we are 30% hedged at $2,500 for the second half of FY23 and about 5% hedged for FY24 at 3,000. I think that the current prices and the volatility, we are watching it, but we will not hedge at the current levels. We think that there is more upside to the LME.
Clearly, that's pretty outlined with the kind of hedging strategy that the company has been embarking upon. But what is the level that you're now expecting the commodity prices to be at, specifically when I say commodity, maybe aluminium for that matter, because it's a 5% hedges that have been created for the next financial year. That speaks volumes, right? So, any ballpark understanding on that, please?
I think that the fact that we have only 5% hedge shows you the degree of uncertainty in those LME prices for next year. So I think that as you started off saying, it's a fairly uncertain environment. So until the Chinese zero COVID policy, the energy crisis in Europe, the inflationary and the high interest rate environment in the US, these are things that need to sort of settle down for there to be some stability in the commodity prices. Till then, you're going to see sharp ups and downs. And I think the best thing to do in this sort of very uncertain environment is not to speculate on commodity prices and try to increase your hedge percentages.
There have been miscellaneous articles that, of course, you and I have been reading about the China's zero COVID exit policy right now. What's your understanding on that? Do you think it's going to happen anytime soon? Because we've seen a sharp run coming in on the base metal. There is a sharp uptick that we've seen in the base metal prices in the last 1 week or maybe 10 days. What's your assessment? And I'm sure you've been very cautious in not giving out the numbers when it comes to the aluminum business. But can we expect like a good 500, $700 per ton kind of a jump, or you actually anticipating some amount of decline coming in? Just a broad color, if you can provide.
I think that at this stage, the bottom line of LME is more like 2200 because the cost curves are all at that level. So I think that from that level, you can only hopefully see upsides because supply and demand is quite tight, energy prices are high. So I think that there is more upside if the macro environment that I mentioned improves.
And what's your view on the exit talks which are presently prevailing on? What's the sense that you are gathering? And do you see the European energy crisis, solving anytime soon? What's your assessment on that?
See, the current spot prices of energy in the Europe have dramatically moderated downwards because they got enough gas in inventory and the winter has not been so cold. But I think that the uncertainty will come back March and April of next year again. So unless that energy problem of Europe gets resolved, you may see a couple of months where its pricing is low, but it could come back pretty fast again.
And even after that, you're expecting your cost of production to go down when it comes to the Q3 and the Q4, right?
So, see, our India cost of production has got nothing to do with the European energy issue. The India cost of production is a completely domestic issue, and it's related to availability and pricing of domestic coal. So
So
it
how
does, it's not
so how
impacted by anything
so
that happens in Europe.
so how are the coal linkages right now? What's the mix there? What are the prices that we are currently looking at when it comes to the domestic way of looking at things?
Yeah, I mean, today we are still getting only 75% of our contracted linkages. So we are expecting, as coal availability goes up, that 75% will go back to 90% plus, in which case it will have a significant impact on our cost of production.
Sure. Also, a word on the copper division now, because, we've seen that business constantly hitting another 5 billion plus kind of EBITDA level. What's the next new or the new benchmark for that division? I mean, can we expect a better performance coming in from that division going forward? How are we looking at the road ahead for this division now?
I think that in the next few quarters, we are guiding that you should see somewhere between 450 and 500, because the sulfuric acid prices are starting to correct down a little bit. So I think that we'll be somewhere in the 450 type of range. It could be have an upside if sulfuric acid prices go up. We are quite sure that TCRCs from January 1st, the benchmark will go up. So as long as we can maintain our operational steady performance, there should be a reasonable good performance from copper going forward. As you said, last few quarters have been very good for copper.
One final question, Mr. Pai, that I'm gonna have and squeeze in here is steel companies, all of them have reported M2M losses in this quarter. Of course, you as the base metal company hasn't reported any of the M2M, loss out here. Do you expect the same to take place in Q3?
Yes, absolutely. I think that LME has to crash for us to get into that situation. So, so far we have not had to see anything. We are still positive EBITDA per ton, and I don't expect for us to see MTM type of losses on our metals.
All right. Mr. Pai, we'll leave it at that. Thank you so much for taking out the time and speaking to Money Control as always.
Yeah, thank you.